A man opens his retirement account before sunrise and sees almost the same number he saw last month. His coffee is still hot, the house is quiet, and nothing on the screen looks dramatic. But outside that small rectangle of comfort, the ground under money is shifting. Debt is growing faster than trust. Governments need buyers they may not be able to find, and the old hiding places are starting to look less safe. That is why a warning like this lands with so much weight. If you like seeing the pressure building before it becomes a headline, stay close to this channel. What we are about to walk through is not just about investing. It is about knowing where safety changes shape before most people even realize it moved. And in the next 18 months, that difference may matter more than it has in years. Ray Dalio has spent decades studying how empires rise, how debt piles up, and how money changes character when a system gets stretched too far. He does not look at markets as random noise. He looks at them like weather patterns, pressure systems, and fault lines. And when someone like that starts narrowing the field down to only a few assets that can hold up, the message is not casual. It is a sign that the environment itself is changing. This matters because most people still think risk looks obvious. They think danger arrives with a crash, a bank panic, a market free fall, or a man on television shouting into a camera. But some of the biggest losses happen quietly. They happen when your money stays still while your costs move higher, when your bond loses value while calling itself safe, or when your paycheck looks the same but buys less every season. That kind of loss does not feel dramatic at first, which is exactly why it does so much damage. The strange thing about this moment is that parts of the economy still look normal. People are working, flights are full, restaurants are open, and the stock market can still look healthy on the surface. Yet underneath that calm, the machinery is under strain. Governments owe more, interest costs are climbing, central banks are trapped between slowing growth and stubborn inflation, and markets are trying to price all of that at once. It is like watching a beautiful house with a cracked foundation and fresh paint. That is the larger issue behind the title. This is not simply a search for the next winning trade. It is a search for assets that can survive a messy transition, a transition from easy money to expensive money, from confidence in paper promises to a world where people start asking a harder question: what do I actually own and who stands behind it? Once that question enters the room, the list gets short very fast because many assets depend on stable rates, cheap refinancing, calm politics, and faith in institutions. Take away one of those supports and they wobble. Take away two and they crack. Take away three and people discover they never owned safety at all, only a story about safety. Dalio's framework always comes back to the same force. Debt can grow for a very long time until the cost of carrying it becomes too heavy. At first, borrowing helps growth, then borrowing replaces growth, then borrowing is used just to service past borrowing. That is when the system enters a dangerous phase because the old solution becomes the new problem. Think of it in simple terms. If a family uses a credit card to fix a roof during a bad year, that can make sense. If the same family starts using the card to buy groceries, pay utilities, and cover old card payments, something has changed. Now imagine that process at the scale of governments. The numbers are bigger, the language is cleaner, but the logic is exactly the same. And when a country has to issue more debt just to manage the cost of old debt, two things start to matter at the same time. First, who will buy all that paper? Second, what happens if buyers demand higher yields to take that risk? A yield is the return a bond pays. When yields rise, older bonds with lower rates fall in value, which means a so-called safe asset can hurt you badly at the exact moment you expected it to protect you. That is why the next 18 months feel so important. This is the period when the market may stop treating debt as background scenery and start treating it as the main character. If that happens, the old map breaks. Diversification still matters, but the kind of diversification matters more. Owning 10 things that all depend on the same calm system is not true protection. It is just one risk wearing 10 different outfits. So if only a few assets can really make it through this kind of environment, what are they? Not the assets that merely look stable on a sunny day, not the ones that depend on low rates forever, not the ones that need perfect policy timing and endless trust. The survivors are usually the assets that offer one of four things: neutrality, liquidity, scarcity, or productive power. The first is gold. Gold does not pay income, and that often bothers people. But gold has something many financial assets do not. It is not somebody else's liability. That means it is not a promise from a bank, not a payment stream from a borrower, and not a government saying, trust me, I will make good on this later. In a period where trust itself is under review, that matters. Gold becomes important when people stop asking what performs best and start asking what stands outside the chain of promises. That is why central banks around the world have been buying it at unusually strong levels. They are not doing that because gold is exciting. They are doing it because gold sits outside the political system. It does not need earnings, it does not need refinancing, and it does not care who wins the next election. Gold also carries a message. When it rises while confidence falls, it is often telling you that people are stepping away from paper certainty. Not because paper becomes worthless overnight. That almost never happens in clean, straight lines. But because the purchasing power of paper money can fade long before the paper itself fails. A currency can still exist and still quietly disappoint everyone who tried to hide in it. That leads to the second asset, and this one may surprise people. Short-term treasury bills or cash-like liquidity, not long-term bonds, not locking money away for 10 or 20 years and praying rates fall. Short duration means you stay close to the surface. You can collect yield, keep flexibility, and avoid much of the damage that hits long bonds when rates stay high or debt fears rise. Duration sounds technical, but the idea is simple. The longer you are locked into a fixed payment stream, the more sensitive you are to changes in rates. That is why long bonds can swing hard. Short-term bills mature fast. They let you step back, reassess, and redeploy. In unstable periods, flexibility is not boring. It is valuable. Now there is a tension here, and Dalio has spoken about it clearly. Cash may not default, but it can lose purchasing power. That is why short-term liquidity is not the hero of the whole story. It is a tool. It buys you time. It gives you optionality. It lets you survive volatility without selling stronger assets at the wrong moment. In other words, it protects your position even if it does not build your fortune by itself. If these shifts matter to you and you want them explained before they hit your everyday life, keep this channel in your orbit. The market rarely sends engraved invitations. It leaves clues. And the people who do best are usually the ones who learn to read the clues while everything still looked calm. The third asset is not one shiny object, but a category of real things the world cannot function without: commodities, energy, industrial materials, the raw inputs of daily life, oil, natural gas, copper, agricultural goods, and the businesses that control or produce essential resources. When debt rises and money weakens, hard inputs often regain power because they live in the physical world, not the world of promises. You can print currency. You cannot print copper. You can expand a central bank balance sheet. You cannot create a barrel of oil with a policy speech. When inflation sticks around or supply chains tighten, real assets start reminding people what the economy is actually built from. A smartphone, a house, a power grid, a tractor, a hospital, a data center, a car battery. All of them begin with things pulled from the ground, grown from the land, or transported across strained systems. That is why commodity exposure is often misunderstood. People think of it as a rough, old-fashioned corner of the market. But in periods of monetary stress, commodities can become brutally modern. They are where policy collides with reality. If governments spend, stimulate, subsidize, and rebuild while supply stays tight, The price of real things can keep pressure on the whole system. In that world, owning some of the scarce inputs matters. The fourth asset is the most human of the four: strong, productive businesses, not just any stock, not the weakest companies living on borrowed time and borrowed money, not firms with beautiful stories and ugly balance sheets. I mean companies that produce something essential, carry manageable debt, generate real cash flow, and can raise prices without losing their customers. When money gets shaky, productive power still matters. This is where many people get confused. They hear that debt is dangerous, inflation is sticky, and policy is messy, so they decide all stocks are poison. But owning a good business is not the same as owning a fragile speculation. A strong business is a living asset. It can adapt, improve productivity, cut costs, pass through price increases, and grow through disorder. That makes it very different from a long-term bond locked into a fixed return while the world changes around it. Picture a company that makes critical software for hospitals, or a firm that supplies a part every power utility needs, or a business that owns infrastructure with stable demand. These are not fantasy stories. These are productive engines. If the currency loses some purchasing power, the bondholder is stuck. But the well-run business may be able to adjust its pricing, protect its margins, and keep serving a need the world cannot skip. That is why productive equities still belong in the conversation. So the four survivors are not random: gold for neutrality, short-term liquidity for flexibility, commodities and essential real resources for scarcity, strong productive businesses for durable cash generation. Each one responds to a different form of pressure. Together, they form a different idea of safety than the one most people were taught during the years of easy money. And that old idea of safety is exactly what is now being tested. For years, many investors believed the safest path was simple: own broad index exposure, lean on long-term bonds for protection, hold some real estate, and trust that central banks would smooth out any trouble. That worked in a world of falling rates, low inflation, and expanding globalization. But when the backdrop changes, the old winners do not always keep their crown. A retiree named David might feel this more clearly than a fund manager ever could. He spent 40 years saving. He did the sensible thing. He bought bonds for safety, kept some cash, paid off the house, and trusted that retirement would mostly be about managing spending. Then prices climbed, insurance rose, food costs stayed high, property taxes bit harder, and the bond fund he thought was stable lost real value. His account did not explode, but his peace of mind did. That is how wealth transfer often begins, not with one spectacular collapse, with a slow reordering, from people holding claims that are losing quality to people holding assets that can adapt, from passive comfort to active awareness, from paper wealth that looked larger on a statement to real wealth that holds purchasing power in daily life. The transfer feels invisible until a few years pass and the gap becomes hard to ignore. Some viewers will hear all this and say, if things are that dangerous, why not just sit in cash and wait? It is a fair question. Cash feels clean, cash feels obedient, cash gives a sense of control, but cash is only as safe as the purchasing power it preserves. If inflation stays above your return after taxes, your cash is not standing still, it is shrinking politely. Others will ask why long-term government bonds are not on the survivor list. Aren't government bonds supposed to be the classic refuge? Sometimes they are, but in a period where the supply of debt is enormous, the cost of servicing it is rising, and buyers begin to hesitate, long duration can become a trap. You are taking a fixed stream of payments across a future that may not stay friendly to fixed promises. That is a very different kind of risk than people got used to over the last few decades. And then there is real estate. Many people still believe property is the one asset class that always survives. But real estate is not one thing. It depends on location, leverage, taxes, insurance, maintenance, refinancing, tenant quality, and the cost of money. In an environment of higher rates and slower growth, highly leveraged property can stop feeling like a fortress and start feeling like a heavy machine with an expensive fuel bill. Real assets help, but bad financing can ruin a good asset. Would you rather own a fixed promise from an overstretched system or a stake in something the world still needs when the promises get shaky? That is not a dramatic question anymore. It is becoming a practical one. And if these are the kinds of questions you want to keep exploring together, stay with this channel as the picture develops. Now let's widen the lens. Dalio's warnings are never only about one market. They are about the structure of the world order. Debt, money, reserve currency status, internal politics, external rivalry, productivity, and trust all move together over long arcs. When a dominant power carries rising debt, prints heavily, faces political division, and watches other countries diversify away from its currency, the strain does not stay local. It spills across bonds, trade, commodities, and capital flows. The dollar still sits at the center of the system. That is a huge advantage. It gives the United States more room than almost any other country would have. But room is not the same as immunity. If too much debt must be absorbed and too much issuance hits the market, the system can respond in painful ways. Higher yields, weaker currency purchasing power, financial repression, or some mix of all three. Financial repression is when savers earn less than inflation while debt gets reduced in real terms over time. That last part matters because it is how many debt problems are handled, not with one giant default, not with a clean confession, but with years of money that buys less, returns that fail to keep up, and savers who discover they were quietly paying the bill. That is why a portfolio built only on nominal safety can fail in a period of real loss. Nominal means the number on paper. Real means what that number can actually buy in life. A normal family can feel this without ever reading a central bank report. They feel it at the grocery store. They feel it when a used car stays expensive. They feel it when medical costs rise faster than expected. They feel it when home insurance jumps. They feel it when their savings account earns interest, but their monthly budget still feels tighter. By the time policy language reaches dinner tables, the trend is already old. That is why the next 18 months may become a sorting period, not because every market will collapse, not because one apocalyptic event is guaranteed, but because investors may be forced to separate appearance from function. Which assets merely looked stable during the era of cheap money, and which assets can still stand when growth slows, debt costs rise, and trust gets thinner. That separation is where a lot of future performance will come from. There are at least three realistic paths from here. The first is a soft cooling period. Growth slows, inflation eases somewhat, and markets adjust without a major break. In that case, short-term liquidity remains useful, strong businesses keep doing their job, and gold may stay supported because long-term debt worries do not vanish just because one inflation report looks better. This is the least dramatic path, but it still rewards discipline over complacency. The second path is stickier and more uncomfortable. Growth weakens, but inflation refuses to fully behave. That is called stagflation. It means the economy feels tired while prices keep leaning on households. In that world, long bonds can struggle, weak companies get squeezed, and hard assets matter more. Gold, commodities, and pricing power inside businesses become much more valuable than elegant forecasts. The third path is the one Dalio worries about most, a debt market shock. Not necessarily a crash in the stock market first, a disruption in the bond market or funding system that forces policymakers into ugly choices, support growth and risk more inflation, defend the currency and accept pain, step in to stabilize markets and risk undermining confidence in the money itself. If that happens, the assets least dependent on trust may become the anchors. At this point, someone always says, but hasn't the United States handled every crisis before? Yes. That is why the doubt is reasonable. Strong systems bend, deep capital markets help, Innovation helps. The reserve currency helps. And policymakers have many tools. But handling a crisis does not mean preserving everyone's purchasing power equally. A problem can be managed in a way that still punishes the wrong balance sheet. That is the part many people miss. The system may survive while your specific savings strategy does not. The market may recover while your bond fund remains damaged. The economy may avoid collapse while your cost of living keeps rising. A nation can remain powerful while its citizens still feel poorer in slow motion. So the question is not only whether the system survives, it is whether your assets survive the way the system survives. If this lens helps you see the world with a little more precision, keep following along here. The loudest voices usually arrive after the move. I would rather meet you earlier when the evidence is still scattered and the choices are still yours. So how should a normal person think about all this without getting lost? Not by chasing every headline, not by trying to predict the exact month of the next break, and not by turning every warning into a bunker fantasy. A calmer framework works better. Think in layers. First, what keeps me liquid? Second, what sits outside the promise system? Third, what owns scarcity? Fourth, what produces real value no matter who is in office? That is the hidden elegance in the four asset idea. It is not really about four tickers. It is about four kinds of resilience. You want some money that can move. You want some wealth that does not rely on someone else paying you. You want exposure to things the world cannot print. And you want ownership in businesses that can keep earning through turbulence. That is less flashy than prediction, but much more durable. It also changes your emotional state. When everything is built on one assumption, every headline feels like a threat. When your assets are built around different forms of strength, you stop reacting to noise the same way. You do not need a perfect forecast. You need a structure that can take a punch. That is a much more adult way to invest. And in uncertain times, adult thinking tends to age well. Another important point here is that survival is not the same as maximum return. Some people hear a warning and still go hunting for the hottest trade. That misses the point. When the tide is turning, staying whole can beat swinging hard. If the environment becomes hostile to leverage, fragile narratives, and long-duration promises, then boring strength can outperform exciting weakness by a very wide margin. That is often how the quiet winners are made. And remember who gets hurt first when the cycle turns? The saver who trusted cash forever, the retiree who believed bonds were simple, the homeowner who refinanced too aggressively, the company that lived on cheap debt, the government that assumed buyers would always show up, the investor who confused liquidity with safety. These are not bad people making foolish choices. They are people using an old map in a landscape that has started to change. Would you recognize the moment when safety stops being where everyone said it was? That may be the most important question in this whole discussion, because by the time the answer feels obvious, prices will already reflect it. Preparation has a lonely phase. It happens before the crowd agrees. And that is why so few people do it well. So yes, the title sounds dramatic. Only these four assets will survive the next 18 months. But underneath the drama is a very calm idea. In a debt-heavy, trust-sensitive world, the strongest assets are the ones least dependent on perfect conditions. Gold for neutrality, short-term liquidity for optionality, commodities and essential resources for scarcity, strong productive businesses for durable earning power. Notice what all four have in common. They either stand outside fragile promises or they retain value when fragile promises come under pressure. That is the thread, not hype, not magic, just structural strength. And when the world becomes more unstable, structure starts mattering more than stories. There is one final reason this warning deserves respect. The next 18 months may not just test portfolios, they may test beliefs. Beliefs about what money is, beliefs about what safety means, beliefs about whether governments can print their way through every corner without side effects. When belief changes, capital moves. And when capital moves, the world feels different very quickly. So if you have been waiting for a cleaner signal, this may be it. Not a scream, not a panic, a narrowing, a disciplined reminder that in late cycle environments, not every asset deserves equal trust. Some are built for comfort, some are built for survival. And when the weather truly changes, comfort is usually the first thing to disappear.